Welcome to another Intelligent Investor video. My name's Gaurav Sodhi. I'm here with my colleague Alex Hughes. Welcome, Alex.
Thank you, Gaurav.
Alex, this is the second Intelligent Investor video we're doing, and we've been asking people to come up with names for this little segment, and we've got a few interesting entries. And I just thought I'd throw a couple at you, see how they go. Now, keep in mind that Carlisle isn't here this week because he didn't laugh at my jokes last week.
Right.
No pressure or anything, but just keep that in mind.
Okay.
All right, so we've got Intellivision. No?
It's okay.
I thought it was kind of clever. I quite liked Intellivision, but it might be a little bit out of date since television almost no longer exists.
I know you're a Star Trek fan, Gaurav, which
is why I like the next one, which is probably my favorite and the one I'm going to use this time. Stocktake. Nothing?
Yeah, it's probably better. Maybe we can run with that today and see if it sticks.
All right, we might go with Stocktake this time, but if it sticks, we're going to have to do justice to it. I think we need pointy ears and costumes at the very least.
Right.
And we can bring in faces at some point too.
Okay, maybe for next time.
There it is, Stocktake, that's what we have. Alex and I thought we'd talk you through a concept that gets brought up in investing an awful lot, but very rarely gets explained. Alex, the idea of scalability is one that value investors and investors in all quality businesses tend to chase. It's very difficult to find, although lots of companies claim to have it. What exactly is scalability?
Scalability is a concept, and for me, the best way that I like to think about it is that when a business becomes bigger, it becomes better. I mean, to put it as simple as that. We mentioned Thorn Group last week in a report to our members, and I think the example of that business is quite instructive about how scalability works. So just for the people that aren't aware, Thorn Group is a subprime financing business. Its best asset is radio rentals. And in this business, they fund the purchase of everyday items like electronics and furniture for low-income consumers. And if you run through their business from start to finish, you see the benefits of scalability in many aspects. So to have a leasing business, you need to have some equipment. So the first thing is they need to source some products, whether it be TVs or couches and so on. And because they're the biggest in the space, they're about twice the market share of their nearest competitor. Their buying power allows them to get better prices, and having better prices means that they can charge lower prices to consumer, and the consumer benefits, and they can have a stronger market position. So that's just one area where scalability benefits them. Another is funding costs. They're a big diversified business across Australia. They're a listed company as well, and they compete with private companies. So because of those facts, they actually get cheaper bank debt from the banks relative to competitors, and that's what really matters. Relative to competitors is the important point there. So lower funding costs means that they can earn higher returns.
A technical explanation, I suppose, of scalability, if you wanted to use jargon-infused language, it's when the marginal margin, so the margin from the additional customer, is far greater than the average margin. And a business that demonstrates that particular characteristic, that I cover anyway, is Amaysim.
Okay. What does Amaysim do, Gaurav?
Amaysim, Alex, in case you haven't been reading our reports, is the mobile virtual network operator. It leases mobile spectrum from Optus, and it sells it under its own brand name with its own plans to its own customers. So when if we assume that Amaysim has, say, 100,000 customers, the average margin on those customers will be fairly low because there's lots of upfront and fixed costs that have to be covered by customers early on. But the 100,000th and first customer will have a much higher margin than the average margin of the existing customer base. So as the business grows, the average margin tends to expand in greater proportion to the customers added. And you can see this really clearly from the annual result this year and from previous annual results. As the business collects customers, what looks to be fairly mediocre economics actually transforms into quite spectacular economics. The profit growth is much higher than the customer growth, and every customer that gets added to the network adds disproportionately to the profit pool. That's scalability at its best. And Alex, you would know, I think, better than anyone else that there are some industries that demonstrate this better than others. And there's one classic industry, which I know you love, that demonstrates this particularly well.
Yes, I guess you're referring to software
It would
there.
have to be software.
Yeah,
Your favourite.
I guess SaaS companies are a great example.
Yes.
And following on from some of your points.
We should probably explain what SaaS is.
Yep. Well,
It's not something that you demonstrate in the office on many occasions, but it is something you talk about a lot. So let's explain what SaaS is.
Yep. So SaaS stands for software as a service,
Okay.
and what that means, that as a service part of the description is that you consume that software through the internet. So that software isn't stored on premise on the hard drive of your computer. It's actually stored externally on someone else's hardware, and you just consume that software and pay for it as you go. Now, an easy example is Xero. They're taking the world by storm in accounting software there, so that's an easy SaaS company to refer to. But there's many types of SaaS companies for many different applications.
And again, it displays those same characteristics we've been talking about. An initial product gets built and then gets rolled out at very low marginal cost, and every customer that gets added to the product adds very high incremental margins. So the more customers they have, the higher the average margin.
Absolutely, yeah. And with the SaaS companies, you also get great benefits with development, referring to the old world model, which is license-based software. And in this case, a user of that software owns that license and consumes that by themselves. And if they want to develop that and improve that software, that development spend only benefits themselves when they use that particular license. But in terms of a SaaS model, when that development spend can benefit all users, you get incredible economies of scale there. So that's really the most powerful part of a SaaS business.
And there are some implications for valuation when looking at not just SaaS, but scalable businesses altogether. It means that we're not necessarily looking for low PEs or low earnings multiples all the time. Because scalability will add disproportionately to profit, we can probably pay a lot more in terms of the multiple. Would you agree with that?
Yep. In some cases, maybe this is a good time for the Thorn chart to appear, and I think this illustrates it well. That the chart you'll be seeing now is Thorn's assets of its radio rentals division, and you'll see that over time the profitability of this business has increased of scale. So you can see that as the business becomes larger, it becomes more profitable and hence more valuable. So in this case, it's an example where scale increases the value of a business and would be willing to pay more for it as it scales up.
There you go, scalability. Talked about often, rarely found, finally explained.